There's another program in mathematical finance, which was really a lot of fun, and I've visited Chris a couple of times. He's an excellent co-author, even if he's a little hard to keep up with sometimes. That's good. The paper I'm presenting here today is weird for several reasons. One is this is a mathematics place, and this is a very low-tech paper. Another reason it's weird is this paper was published over 30 years ago. But that was requested, and this paper has been cited a lot and is really a popular paper for building on to do things with financial markets and liquidity. And strangely enough, it is one of the most widely cited papers in finance and economics. And this means that this was published when I was a young kid, like 28, I guess. And it's been downhill ever since. It's of this caliber.
High point to come down from.
Yeah, absolutely. So anyway, I want to talk about this to give an idea of it is something that practitioners care about. Ben Bernanke, I guess, said that he used this to think about the crisis, and that he reread the paper 3 times while he's dealing with the crisis. He said that was important to him. There are 2 different issues, special issues of different Fed reviews devoted to this paper. So people think it's important. People said at one point that it helped explain the Asia crisis. I don't think it does. I think it was not a good model for that. It had some common features of liquidity and possibly multiple equilibrium, but it was the wrong model for that. But other people have said now that there are a lot of things in the financial crisis that are explained well by this theory. And the big thing, which is probably a good model, and is probably the biggest thing in the crisis, is the run on the shadow banking system, the collapse of the shadow banking system. Other things which have been argued for this, and you'll see a list of these in Ned Phelps' introduction to the Richmond Fed issue on Dybvig a couple years ago, included the run on the money market funds, which looked just like a Dybvig bank run, and run on the bank commercial paper, which was related. The run, there's actually a contagion there. The run on the money market funds got them to drop all their bank commercial paper, and then there's a run on bank commercial paper. And it's hard for you have a deposit and you want to keep the deposit in your bank. Their option to leave is a lot like the option to roll over your investment if you have an investment. They're just 2 sides of the same coin. It's just a question of which one is the default. Whether the default is that you leave it in, or whether the default is that you take it out. So there's been a lot of interest in this stuff. One thing about this model is because it's extremely simple, people have been able to extend it. We worked extremely hard, actually, when we were working on it, to make it as simple as possible, as clear and crystalline as possible. And I think that's one reason why it's successful. It's kind of a shame that these days there's a trend towards you can't get anything published unless it's really complicated, and there's a whole smoke screen of junk going on. And that's, that may be necessary for publication, but it's not good for something that's useful for other people to build on. So our original thought about this is that we would model bank runs as a rational phenomenon with multiple equilibrium. So the idea is if you have a bank that's sitting there and the liquidation value of the assets is less than the claims that people have in their demand deposits, that if I think everybody else is gonna take their money out, I better take my money out too, because the bank's gonna run out of assets. If I don't take my money out now, there's not gonna be anything left. And that was the basic idea that we started with. If it had been just that, I think it might have been an okay paper, but it wouldn't have had a big impact. If, the important questions are why would you ever set up a bank that would have this feature? This just sounds like a silly arrangement. And so what we have is we have a model in which it's useful to have a bank that has these contracts that are potentially subject to runs, they have a good equilibrium. A good equilibrium is you don't take your money out. If you don't think everybody else is taking their money out, then you won't take your money out unless you really need it. I mean, you'll take it out if you have liquidity shock. Some people have said this is if you know you're gonna die, but I think of it more as you see a house that you really wanna buy, or you wanna help your kids in college, or whatever is the need for your money, a sports car that you fall in love with. You have some preference shock that means that that having your money now is much more valuable than having it later. And in a good equilibrium, you'll take your money out if you have that preference shock that says that you really need the money now, but you won't take your money out if in fact you don't need the money now and you can wait. But if you think everybody else is taking their money out, then you're worried about the bank running out of assets, and you'll take your money out. One of the big barriers we had in getting people to accept this paper is that people in economics didn't think multiple equilibrium was right. They thought, in the macro class, they say, you must have a unique equilibrium because otherwise it's not a real economic model because you can't do prediction. I think that this paper has helped people to get over this, that there are things that are interesting because of the multiple equilibrium. There are also strands of literature that try to push it back into a single equilibrium and find a unique equilibrium. And some of those will make some strong assumptions. Maybe I'll get to some of that in the next talk. But I'm not going to, I'm going to try to stick mostly to the original model in this talk. And it turns out that deposits in this model are a way of implementing the optimal contract. I like optimal contracting as a framework. Usually what happens in optimal contracting is we have some way of deriving what is the optimal contract, say through the revelation principle or whatever. And then we go out either into the world or in our imagination and try to think about how that could be implemented. And it turns out that a good equilibrium, this model implements the optimal contract. It doesn't, and if you generalize them all a little bit, we'll talk about that. Further thoughts. I mentioned part of this before. This is what I call a toy model. Toy model is not a bad thing. A toy model is a model that's intended to show the internal consistency of some economic ideas or economic argument and help you to understand how it works. It's not something that you would sensibly take out and take to the data. I can talk about some implications of this model and how you might look in the data to see whether this model is relevant. But this is a model with two periods, two types, or three, it's a very simple model that you can't take to the data. I mean, I would take this as a contrast to something like Black-Scholes model. You may not like the constant volatility assumption, but this is a model that you can go out and test. You can say, do the option prices in the market fit the model? And that I think of as a realistic model. You can say, okay, well, we can reject this, and then we put in a model which has stochastic volatility or interest rates moving around, whatever we have to make it fit better. But that's a realistic model. It's intended to be taken directly to the data. This is a toy model, which is more conceptual and more for thinking about how things work without being something that in this form you would take very literally. And as such, we tried very hard to simplify it to the point where it only has what it needs in the model. And it's kind of like a poem or a crystal. It's just supposed to be, state very clearly what it is that's going on in this setting. That helps to make it clear what's driving results. And it also makes it so that you can generalize the model. We haven't used, when we do theory, any good theory is not the same as the world. The world is much more complicated than we can solve and say something useful about. So the theory is always kind of an analogy, which is to say, the world is as if people have these preferences and have this information set and so forth. And we're always on this, have this tension between what's tractable and what we can say something about and what's realistic. And we try to use our intuition to put in the parts that we think are most important and driving things. And so, and we're always up against this. We have limited number of degrees of freedom of what we can actually analyze, and that's going to limit what assumptions we can make. In this case, we're going actually to an extreme, and we're going to say, we're not going to write down the most complicated model we can analyze. We're going to write down the simplest model that has what we need in it. And the result is that there are a lot of other papers that build on this and can do other things. We've left some degrees of freedom for other people to work with. And I think that that's a useful thing, and it's certainly hard to get published these days, anything that has this kind of flavor. But that's the style of this. Anyhow, after a long introduction, let me talk about this. So, bank runs in their model are a rational phenomenon. We look at the two pure strategy equilibrium. There's a mixed strategy equilibrium in the middle. I don't think it's that interesting. I won't say anymore. But there are two equilibrium we focus on. One equilibrium is this equilibrium where you implement the first best. The other is equilibrium with a bank run. And the bank run doesn't have anything. The literature up to that time had talked about panic and psychological stories about bank runs. There's none of that in here. Given that you think everybody else is going to run in the bank, it's completely rational for you to run in the bank. Banks create liquidity if and only if runs are possible. You can set up a bank with a promise for the returns that mimic the illiquid assets that you have, and so people can only take out at a low value that wouldn't cause the bank to fail even if everybody takes their money out. But if you do that, the bank doesn't provide any improvement on risk sharing, doesn't provide liquidity. And then for policy things, bank runs can be eliminated by deposit insurance or discount window. For reasons outside the model, deposit insurance is more reliable. For reasons outside the model, deposit insurance can also cause more problems. And probably I won't get into that, and probably you know a lot about that anyway. One of the things that's interesting about this paper, actually several of my early papers had multiple equilibrium. This is also true on my paper with SPAD about network externalities, is that in some of these models, the role of policy is not, the traditional role of policy in economics is you take an equilibrium and you insert some taxes and transfers and things, and that helps you to achieve some social goals, but it tends to distort some other things, and there's a trade-off. There's a whole optimal taxation literature that talks about that. In this model, it's different. The role of policy is to leave the good equilibrium alone and to eliminate the bad equilibrium. So if you have deposit insurance in place, then even if you think everybody else is going to run, you say, nope, it's not a problem for me, because I know I have the deposit insurance gonna protect me and I'll get my money back. And then you don't run it. So that means that what was a bad equilibrium with the bank run no longer exists. In this idealized world without any uncertainty and so forth, it's costless. In the real world, of course, it's costly. There's other issues going on. So anyhow, those are some of the main ideas from this. Okay, so in the model we have bank assets. Bank assets are illiquid. So in the world, we really think, and this is what Doug and I were thinking about at the time, think that bank assets are illiquid, mostly because of information asymmetry. If you have a bunch of bank loans and you want to sell them, financial intermediation is an information business. And the information you have is that you have skill in evaluating and monitoring loans. That's part of what banks do. And so you have this portfolio. People sometimes use the term opaque because it's really hard for people outside the bank to see what it's really worth. And so if you want to sell some bank loans, you're going to end up with adverse selection problem. People are going to be very skeptical that they're good. It says, the bank has information I don't about these loans, why are they trying to sell it to me? I think I know why. It's because they're not any good. And so as a result, bank loans are illiquid.
Regarding what you just said, that doesn't have to be the case all the time. The reason is that the bank can give part of the loans that they're concentrated on a specific sector region, so they have highly capital allocation on that sector region and they want to take out the loans, so they have less exposure there. And let's say the other bank that will buy the loans will not have any concentration on that sector.
There are good reasons to sell off loans, but one of the big issues with loan syndication is that you worry that they're going to syndicate the bad loans and they're not going to syndicate the good ones.
Yeah.
So that's the problem. That's an adverse selection problem. It's there. It's real. Okay. But anyway, that's not what we do in this paper. This paper, we're looking to be very simple. We're thinking of adverse selection and illiquidity, but writing down a formal model that is messy. And we didn't want to use our degrees of freedom there. We're doing something else that's more important in the model. So the way we modeled illiquidity in the model is to say that if you liquidate the asset before maturity, then you don't get a very good return. Now, originally we had, if you liquidate in the middle period, you get something less than your initial investment, and we also had separate investment in some riskless project that had a zero rate of return. And we figured out that we could make the model simpler by just having one. Because if we make the return on the asset equal to 0% return, if we take the money out in the middle, then we don't need the other asset. Okay, makes the model simpler. Okay, so we did that. If you take the return in the middle period and make it a negative return, so you can only get half of your initial investment out for a quarter, because maybe you lent money to a shopping center development and it's half finished, and even they try to liquidate it, they can't get much money out, then all the main results will go through, but this is going to be simpler. Again, we're just making all the assumptions we can to make this really simple. Okay, so here's the technology, and you decide in the middle period which pattern you get. This is times 0, 1, and 2. So you put your $1 in at the beginning, and in the middle period you have to decide at time 1, do I want my money out now, in which case I get 1, or do I want to wait, in which I get R, which is bigger than 1, in period 2. So that's the technology. And these projects are divisible and independent, so you can liquidate a fraction of it if you want at this point. Okay. Oops. Okay. Depositor preferences. So the way that we model demand for liquidity is in terms of preference shocks. They're, depending on the context, this is actually a very realistic way of defining liquidity. If you think of this as somebody who doesn't get a preference shock, but has something happen in their life, they lose their job, whatever, that will work. That will usually work too, and it'll be very similar in most models. Both, if you're talking about in the setting of a company, having preferences is already weird, and having a preference shock is even weirder, and you probably want to talk more about real things happening. But this was just a simple, natural way for modeling this. So we have two types of our agents, type 1 agent and type 2 agents. An agent's type is private information, and it's learned at period 1. It's learned in the middle period. So at time 0, you don't know which type you are. So we have these assumptions on the utility, and in the paper it says you have constant relative, have risk aversion bigger than 1 everywhere. Actually, you better not have that. It's a mistake in the paper. You need risk aversion bigger than 1 for consumption bigger than 1. The reason for that is that in the way that demand deposit works, if you have a run and you don't get any money, you have 0 consumption, and so you have to have finite utility at 0 to get everything to work, but you can't have this. This is true everywhere. Okay, so the paper is written in kind of an old-fashioned economic style, and I would not let my students write a paper this informally. Now, they could write the paper that informally, but they better show me the formal model and the assumptions more carefully than I had a habit of doing at that time. Fortunately, it doesn't really affect the economics, and a lot of useful papers have mistakes on them.
Certainly.
So it's embarrassing, but it's not fatal. Anyway, anyhow, we have these preferences. The assumptions on preferences are just to get, so we don't have to look at 16 different cases, and rather than the case we're interested in the solution. Since we're basically building an example, that's fine. It's not that, if you say, I don't think people are that risk averse, it's like, okay, we can set up an example where people are less risk averse, but it's not that important. Okay, so if it turns out that in this state of nature, you need liquidity, so you're type 1. You find that out again in period 1. For most of the paper, the fraction of people of type 1 is constant. So there's no aggregate uncertainty. There's just uncertainty for the individual. We'd have some analysis in the paper of T-random. You don't know how many papers I got to review that says Diamond and Dybvig assume T is constant and we allow it to be random. Okay, now it's true that they're probably doing something different than we did, but I think if they're going to write a paper that builds on our paper, they should read the whole thing and know that we have a part in there that says what happens if the fraction of people with liquidity stock is random. Anyway, and I've seen that same thing others. I mean, I've also reviewed a lot of papers that extended Cox, Ingersoll, Ross to a 2-factor model and had the whole paper was about an example, which if they'd gone to section 4 or whatever it is in the paper, they would have seen it. So if you're gonna extend a paper, read the whole paper. Okay, so anyhow, there's a continuum of agents. There's an issue about measurability when you have a continuum of agents. We don't analyze that formally, but I can give you references of people who've done nice things with it. Ed Green has something on his website, which seems to be a nice measure theoretic approach. Bob Anderson has used hyper finite number of agents in an economy and low measure, and can do the same thing. People have also worked with sequence economies, which are messier. We're just going to go directly to the conclusion of those papers and assume that the population average and realized average is the same, which makes sense from kind of a law of large numbers intuition, the fact you have infinitely many agents. Oops. Okay, so endowment, everybody has 1 unit of the single good at time 0 and nothing in the later times. And people might have access to the technology themselves. If they did, then they would do what you might expect. They would invest in since they only value consumption at times 1 and 2, they invest all of their endowment in the technology. And if it turns out that they are type 1 and they need to consume immediately, they'll liquidate the technology in the middle period. And if they don't get the shock, then they'll wait and consume at the end. If they get the shock, which says that they're type 2. If they learn that they're type 2 and they're patient type, then they'll wait and get the higher return and consume at the end. And that's the same as a competitive equilibrium if it's just based on public information, on no public information, and you have prices for consumption through periods 1, 1, and R inverse. So it's the price of consumption at 1. You can think of the price of consumption at time 0 as the numeraire, then the price of consumption in time 1 is 1, and the price of consumption in time 2 is R inverse. So, and you can sort of see that you can realize those prices just by investing in this illiquid asset. So you can get consumption at time 1 for the price of 1 by investing in the illiquid technology and then liquidating in the middle. You get 1. You can get R in the second period, so it's a price of R inverse per unit in the last period by investing in the liquid technology, or in the technology at the beginning and not liquidating, and then you get R at the end. So for each unit of consumption has a present value of R inverse. That costs R inverse per unit of consumption at the end. So that's the competitive equilibrium if the prices are not contingent on anybody's types. Now, if you look at the perfect information, so that say a social planner can observe all the types in the middle period, and you look for an efficient allocation, all the agents are symmetric, and there's enough concavity here, so you get a symmetric solution. The symmetric solution says that patient agents consume later and impatient agents consume earlier, so that's the same as what we had up there, but the amount of consumption is bigger. So what will happen is that you can think of this as insurance with the asymmetric information. The people who consume earlier consume more than they would under this autarky or uninformed equilibrium solution, and then the people who consume later consume less. The assumptions about the utility are to prove these things. So this is going to be the efficient risk sharing is for people to get more than they would just by investing in technology themselves. You can also think of this as smoothing interest rates. I had a student, Jianping Qi, who's at University of South Florida now, who had a really nice paper in RFS, which was an overlapping generations version of the model. And you'll see that this is kind of general in the sense that having the banks allows you to smooth interest rates over time. And that's part of what's going on here. So you'll get a bigger interest rate going from period 0 to 1 than before, and a smaller interest rate from 1 to 2. In this solution, in the autarky or the no information solution, equilibrium, then the interest rate is 0 from the first to second period, and it's positive from the middle period to the end. Here, the interest rate is going to be bigger from time 0 to 1 and smaller from time 1 to 2. And that improves risk sharing, and that's the advantage of the liquidity provision. That's what the liquidity provision does for you. Okay. So you have this resource constraint that says this is going to be the fraction of people who are type 1, and this is what they consume. And so you have to invest 1 unit for each of these at the beginning. And here's a fraction who are going to be type 2. And I should have subscript 2. But this is how much they're going to consume. And it costs 1 unit of initial investment for each R units of consumption. So those have to add up to 1, which is how much you have the endowment per capita at the beginning. And then, these things, as I said. This one follows from that one because of the resource constraint. If you do the autarky solution, this is going to be 1, that'll be R. If you allocate more of the initial capital to providing this, then you're going to get less out in the second period. So this optimal allocation is incentive compatible, so we should be able to implement. Incentive compatible means that none of the agents in the economy want to pretend they're a different type. And if somebody had an incentive to pretend they're a different type, your type is private information, this wouldn't work. But in principle, this should work. So it should be possible to implement this. Okay, this is just the math that you go through to calculate these things. Okay, so the next point is that the bank, we're going to talk about bank contracts. Bank contracts will implement this. So one of the modeling choices we have here is we want to have some of the flavor of what would happen in a richer intertemporal model without making the model that complicated. And so we've set up what we call a sequential service constraint. So we have an artificial time at a shorter time scale where depositors who decide to deposit or to withdraw their money in the middle period stand in line. And when they stand in line, they're served one after another. And so the main assumption is that when you go in and you say, I need money for the down payment for my car, they don't tell you, well, we don't know whether there's a bank run going on. At the end of the month or the end of the year, we'll give you the money if not too many other people have taken their money out. So that's the sort of thing that we don't allow. Is that when people come up to get their money out, they come to the center to get their money out and then they leave. Interesting point is a lot of models of banking and a lot of models in macro of money require that you be disconnected from the center, that everybody isn't in a common exchange all the time. That's part of the action. And that's the way, that's a piece of it here. And the point is that after I take my money out, I've gone and spent it on a down payment of the car, the bank says, oh, I'm sorry, you can't have your money after all, you have to give it back. You have to give back half of it. So assume that you need that money to do something, and they can't really just wait till all the ones are there. The other thing that's not going on in their papers about this, that I think are barking up the wrong tree, it also says that you can't, the bank cannot learn everything it needs to learn just by looking at the order flow. So you could imagine a model, let's say that we modeled this withdrawal process as withdrawals are coming in at random times on interval 0, 1, and each one is each agent who takes money out is uniformly distributed on 0, 1. Then after like epsilon amount of time, you'd be able to look at the withdrawal rate and figure out how many people are taking their money out, and you know whether there's a run or not, and then you could, we don't let people do that. I think when there's a run going on, modeling this is complicated. If you write down a simple model, you'll be able to make inferences like this. But when a run's going on, you don't know how fast money should be going out during a run. You can't figure it out. You don't know whether people just, a lot of people got raises, and so a lot of people are buying new cars, or what's going on. And so in our assumption, it's fine, because you're just saying that people are waiting in line, and you know the place in line, but not anything about how long the line is or timing or anything. But that's an assumption, and there is a literature that starts to talk about how you would model that to get that feature out, even though you have some kind of intertemporal explicit thing going on in some uncertainty like that. Okay, so anyhow, you have all these people who stand in line and get their money out, and any money that's left over is divided up equally among the agents in the last period. Making this a mutual bank that's owned by the depositors, and the depositors get the residual, is another way we made the model as simple as possible. We don't want to have separate owners of the bank, or bondholders, or this or that. And the other thing, we just want to make it a mutual bank because we didn't need the other stuff. Anything we didn't need, we threw it away. Just want to make it as simple as possible. So, if too many people take out the money, then there won't be any money left over. For simple demand deposit contract, the bank is required to give them what was promised, the R1, and that's just what they give them. You can talk about other contracts where they give you different amounts depending on your place in line. And you can't get to the first step. If the fraction of people who withdraw, who get the liquidity shock is random, having different payments for different places in line can be useful to improve welfare, but it can't get you the first best. Because the first best would give everybody who withdraws the same amount.
So does that mean then at time 1, everybody who's put a deposit in would get R1 and they would consume it at that time?
And until the bank's assets run out.
Yeah.
And the rest, if the bank's assets run out, the rest consumes 0.
Yeah.
And that's why we need U of 0 finally.
Right.
Okay. So basically, so if the fraction withdrawing is less than 1, then we have this. This is the amount left over divided by the number of people who are left. And then you get the larger of that and 0. So if there's nothing left, if you didn't have enough to satisfy the fraction, if that fraction F took their money out, if you didn't have enough to satisfy those people, you have one, for each depositor, you have 1 unit of deposits. And when the liquidation value is 1, and so if you have fraction F, you give them R1. If F times R1 is bigger than 1, then you exhaust all the resources of the bank and you haven't paid everybody. If it's less than 1, then you have something left over, and that's divided up equally among the remaining people. So if you have nothing left over, this is negative, and you have the max at 0. If you have something left, you need a separate formula when F equals 1, because you don't like dividing by 0. And at least I don't like dividing by zero. And here's what it comes out to. And so what happens is that if R1 equals 1, then you'll be able to satisfy everybody. And if somebody decided to wait, then they would get their money afterwards. If you have R1 bigger than 1, and everybody tries to withdraw, then you're going to exhaust all the money, and somebody who waits won't get any money. So anyhow, when R1 equals 1, you have no incentive to withdraw, but you have no reason to be in the bank either, because the bank contract pays the same as what you would have had if you just invested in the technology in your own backyard. Okay, and as I mentioned, there are two types of pure strategy equilibrium. One is a run where everybody withdraws. If you think everybody else is going to withdraw, if R1 is bigger than 1, then you'll take all your money out. Then you'll take all, if you think other people are withdrawing, you'll withdraw too, because you know that everybody else withdrawing is enough to exhaust all the bank's liquidation value. Then there's a no run equilibrium like this. If R1 is not too big, so if T times R1 is less than 1, then you're making a promise that's not too big, and you have this no run equilibrium as well. In particular, if you set the interest rate to be the one in the first best solution, the promised payment, and if you take your money out early, then this will implement the first best. What's left over in the bank is given by the same budget constraint as in the social planner's problem. And so this is what's left over, and that will implement the first best. So a couple technical things. I mentioned this before. You can't draw infinitely, uncountably many random variables that are independent and expect to do an integral across them, because it's not a measurable function. The inside measure and the outside measure calculation will give you the whole range of the random variables possible values of the integral. So you have to do something about that. We do it by brute force. We just assume that sensibly that the population average is equal to the average from the distribution that they're all drawn. But there are other things that you can do with that. And also, here's our mistake with the U0 finite, and that's how to fix it. It's fortunately easy to fix. Okay, and as I mentioned, government policy is normally thought of as moving an equilibrium locally through tax and transfer policies, and that causes some distortions, and you trade off the distortions against the social goals. So when you tax a company, and then you take the tax revenues and you give it to poor people, you have a social goal of reducing income inequality and helping the poor people to do better, and you're balancing that against the distortion. The company will have an incentive to produce less, and those are the kinds of calculations people traditionally did in taxation. This one is different. This one, there's not a trade-off directly. You're just saying there are two equilibria here. One of them is bad. Let's get rid of it. My earlier work with Chester Spatt on adoption externalities would be something like a telephone network. If I have a phone and you have a phone, and everybody has a phone, maybe that's the efficient equilibrium. It's also an equilibrium for nobody to have a phone. Why would I get a phone if I can't call anybody? And so maybe in a setting like that, the social policy is to subsidize people who are earlier, who buy phones early, or to make a contingent subsidy contingent on the network not developing. Given that subsidy is there, everybody's going to buy a phone and they don't have to pay the tax. They don't have to pay the subsidy. So it's another example of this. So that was like Journal of Public Finance, 83, something like that. Public Economics, I can't remember, something like that. Anyway, so with the multiple equilibrium, you have this different kind of role for policy. Here's some ways of doing it. Suspension of convertibility. So it could be that the bank has a policy, or it's dictated by government, either way. They say, we know that there's only a fraction T of the people who have the liquidity shock. If people withdraw up T plus epsilon, we have T plus epsilon people withdrawing, T plus 1 people withdrawing. That's the wrong units. Okay. If we have some more people withdrawing, a chunk more people withdrawing, we're just going to shut it down. And so we'll give it to 1% more than a fraction T, but after that, we won't honor any claims after that. So what that does is it says that if I'm thinking about running the bank, I'll say, well, I know they're going to shut it down, so there's still going to be money there for me next period. And so I have no reason to run in the bank. So if you have your patient type, you have a dominant strategy now not to run in the bank. Okay. So that's suspension of convertibility. Suspension of convertibility actually was done in some of the banking crises in the past. And it's really damaging because it means that the people who come in afterwards, who really need the money, can't get it. And in particular in this model, if you take it very literally and say the fraction of type 1s is non-random, then the only equilibrium after you put in this policy, 1% bigger than T withdraws, that you suspend convertibility and you don't let people take their money out anymore. Well, the only equilibrium then is for people to withdraw when they just have the type 1. But if you make the fraction of type 1s random, then what's going to happen is that people will not, you don't know how to implement it. Whatever point it is that you place the suspension, you're going to get some realizations where there's a larger number of people than that who want their money out legitimately, and they're not going to be satisfied. And so that's very costly. Another thing that you can do is a discount window. Discount window is the Fed lends money to banks when they need cash. The problem with the discount window is it's discretionary and it may not be a credible promise. That people may be thinking, oh, the Fed's going to try to decide whether the bank is solvent or not. Now this is out and whether the bank actually has the assets, risky assets that are a problem. So is this just a temporary liquidity crisis, or are in fact the assets unsound? And that's outside the model, but I think that's a practical problem. It's not an ironclad commitment. Deposit insurance is probably more reliable, but it has this whole set of other issues that go with it, again, that are outside the model. Deposit insurance, if you know that your deposits are insured, you don't care if the bank's assets are exhausted. You'll be paid off, presumably through some seigniorage, printing of money, or taxation authority of the government, and you'll get your money that way. And in equilibrium in this model, where the fraction of type 1s is non-stochastic, that can be done without any cost. You make that guarantee, it never happens. Of course, in practice, if we've built this model without risky bank access because it's obvious that banks can fail if the assets are risky. We wanted to show that the banks could fail even if the assets are safe and if there's no intrinsic problem in the bank. But if you add risky assets, then the deposit insurance fund has to deal with that. And you need some kind of restrictions on what banks can do. It's like the covenants in debt contracts. Private debt contracts, bonds that companies issue have lots of covenants that say you can't completely change the line of business or sell all your capital, et cetera, et cetera. You need similar things to protect and that's because the bondholders are holding the downside risk in the company. Now that risk is transferred to the deposit insurance fund, and you need some regulation to do that. That regulation didn't seem to be so hard when I was a kid, it seems to be hard now. Current institutions like Basel are a lot of the problem, that's another talk. But anyhow, these are three examples of policy which in the simple model all work equally well if T is non-stochastic, but they have practical differences in practice. So anyhow, these are kind of main takeaways, I think, from the model. One is that bank runs can be modeled as a rational phenomenon, multiple equilibrium phenomenon. One thing I didn't touch on, and I think it's just a footnote in the original paper, is that if you expect there to be a run, why you put your money in the bank to start with? And the answer is you put your money if you think the probability of the run is small. And so you can talk about some kind of what's sometimes called a sunspot equilibrium. I don't think sunspot's a good choice because sunspots have real effects in the economy on the radio transmission and so forth. But the idea is it's something that's commonly observable, and you can coordinate on that to pick which equilibrium you're in. And it's supposed to be something that's just pure noise for the economy. But of course you can also substitute something that's not just pure noise. Could be if things are bad enough, then people say, okay, things are bad, we're gonna have a run. I think one reason why banks traditionally built these great big tellers and fancy things is because they're so fragile and they wanted to look very solid. They want to look like they're very substantial and that they would never go away. And it's because they're intrinsically fragile for some reasons described here. So, okay, so deposit insurance, the bank deposits can improve on the competitive outcome, or our talking is they provide liquidity, and that's an improvement of risk sharing. And this has been used to model lots of different things in banking, and you'll see a lot of papers that have basically a Dybvig model, and even cites because they sell a standard model. So that's cool. And then the basic approach can also be used to model liquidity for other contexts. This is a paper on some policy issues that I think people still haven't learned about the things that we talk about there. So that's actually a useful read even today. The only part I would probably change in there is the way we discussed money market mutual funds, because money market mutual funds turn out to be almost just like banks in bad times. So, and that should be part of the discussion. But we treat them as the way that they are in quote normal times, which is that they're not really, the assets and the liabilities are both liquid. Some recent stuff, this includes some lectures at the bottom. I gave some of them in China, so there's Chinese translation, Zhongwen, in the lectures. Some of that beats up on Basel and talks about what the problems are in Basel, which I don't think are fixable, by the way.
You're going to tell us about that in the second talk.
I can talk about that some the second time. I haven't decided exactly what to talk about. The slides for that are kind of after dinner talk things. So if you thought this was low tech, those slides are much more low tech. So I think probably I can spend some time on that. I think I should probably also talk about some. I haven't decided yet. I'm up for suggestions.
Well, I'd like to hear that.
Yeah, me too.
Okay. Well, I can do that. Well, maybe they should put me in the final conference
They
as
certainly should.
as
That's a
a
good idea.
something or other.
Yeah.
Because I I think that's kind of a good topic for general audience.
Yeah, probably
Yeah.
keep that for the gathering of the great and the good.
Yeah, I'm assuming, probably some people from Basel.
Oh, yes.
Oh, dear.
And the various central banks as well.
Yes.
Well, I've talked some with central bankers about some of these things. I was asked to chair a panel discussion at the Atlanta Fed at one of their conferences. And I didn't pick the subject of the panel discussion, but I thought it was great. And the whole point of the conference was financial regulation. The devil is in the details. So there was something about the devil in each of the sessions. And it said, maturity transformation, is it the devil's work? Was the name of our session. And I think it comes from the observation that if you look at what regulators are doing now, they are very focused and very proud that they've made the banks safe. But they have not spent any attention on making sure that the banks can do what we need for them to do. And and that's what the session was about. And the sad thing was that it took a while for the central bankers to even get what we were talking about as this topic of the section that was given. So it's an interesting question. And part of the problem is maturity transformation means several things. This is an example of this, which is liquidity provision. Maturity transformation also means taking on interest rate risk, which I don't think there's much. I think there's much less of an issue in that should be hedged, and that's not such a problem. But this maturity transformation, the big empirical question in my mind is this important in the economy? Is this a function of the banks that we need? Some people say we should have 100% reserve banks that don't provide liquidity, they just hold liquid assets and they have liquid deposits, and we just monitor them for fraud. And that's assuming that the kind of liquidity provision we're talking about, this model, is not important. And that, I think, is a big question. And on the face of it, the answer is it is important, and you can see evidence in the crisis that with the reduction of liquidity, it did huge damage to the economy. But there could be something more subtle going on. It could be that liquidity was priced too cheaply, and firms arranged their affairs to use more liquidity than they really needed, and that's why it caused such a problem when they lost it. I don't know. These are I think it's probably important, but I'm not sure that that's settled. And that's an interesting question.
I like to summarize the current situation as follows, that in the run-up to the crisis, the central banks and the regulators concentrated on macroeconomics and ignored finance. And now they're concentrating on finance and ignoring macroeconomics. I think that sort of fits your previous remarks.
Maybe. I have to think about that. So, Steve Russ once told me that finance is a set of people interested in finance is a set of things people interested in finance are interested in.
Yes.
And so that I have a problem with that. Now he did say that in a setting of, I asked him what I did in my PhD thesis. Asked him whether it was finance, and that's the answer he gave. And so I figured that meant no, but it's okay. So, I don't know. Anyway, I think whether it's finance or not, I don't know. But which part is finance and which is macro, I don't know. But
Yeah, that's the point.
but I think the problem. I'll tell you what I think the biggest problem with Basel is that they don't have good information. They use these coarse accounting numbers. When I was a kid, they had bank examiners who go in and look at the banks, and that's much more information. And now, with this amount of information, you have choices on some kind of a continuum. At least efficient choices. One is that you can then use this extremely coarse information, and because it's so coarse, you put really stringent requirements in the banks, and then the banks can't do what they're supposed to do. The other thing you can do is you can say, okay, we got course information, but the banks have to do some stuff for us. And so we've had really loose regulations, and we understand there are gonna be bank failures. In fact, in the crisis, it shows we had both. In the growth of the shadow banking meant that banks weren't doing what they're supposed to for us. And the fact that problems in the real estate market in the US caused bank failures around the world said that the banks weren't safe. So, and I think it's because Basel just doesn't have the information, can't have the information that they need to do a good job. But anyway, I can talk about, yeah.
Just one comment on this continuum of agents, that's the law of large numbers. At a technical level, maybe we should also mention Sun Yineng next to Anderson.
Oh, okay.
Who did this thesis with low.
Oh, okay.
Low spaces. But it always amazes me that the economist finds that acceptable. Because if you think of a continuum of agents, well, the idea is you have a lot and they are somehow densely packed. And then to maintain the idea that they behave in an IID way is to me completely against any experience and common sense. There will be strong
Oh, no,
interactive
but the point,
events. No, but let me continue. And that means that in the end, this will be a source of a multiplicity of equilibria. So psychology comes in. You said in the beginning, no psychology, and you're completely right, because with this assumption, you completely cut out all the herding effects by assuming the law of large numbers in this continuum of IID agents. But I think, in fact, that's a highly risky situation, which will create also a multiplicity of equilibria. And this can also be made precise.
okay, well, in this paper, it's like the assumption that bank assets are risky. I don't really think that the withdrawals are uncorrelated. In fact, they're not if the T is random. Then they will be correlated, right? This is uncorrelated conditional on T, if T is random. But the point is that even absent that correlation, absent the risky assets, absent any intrinsic problems in the bank, you can still have bank runs.
Yeah, okay.
That's, I mean, for this paper, that's a strength, it's not a problem. But, yeah, I agree, I mean, I used to get all these papers to review from JET. Carl Schell fancied I was a physicist, but I was just an undergraduate math and physics major. But he always fancied that I was a physicist for that reason. You get all these papers from people who say, I can I'm a physicist, I can revolutionize economics because I know how to take a derivative. And they write down these models where
Path integral too.
they have Avogadro's number of agents in the model to make it work, and they have things, everything is operating independently, and yeah, I'm with you on not liking that general approach to things. The number of agents in the economy is much smaller, and they see a lot of common information. But for this model, again, we're building a little crystal or poem. We're just trying to exclude everything but this one effect, and then we want to isolate that.
Well, thank you very much.